statement. It reports a company's assets, liabilities, and shareholders' equity at a specified point in time. This is a financial statement that provides a snapshot of what company owns and owes, as well as the amount invested by the shareholders. Balance sheet provides a basis for computing rate of return and evaluating its capital structure. But do you know what is audited balance sheet? How the auditors read the balance sheet? How to read profit and loss statement? To find answer to these questions, let us go through this module on how to read balance sheet. In this module, you will learn to understand the importance of balance sheet and audited balance sheet. Identify the principles for preparing balance sheet. Explain the importance and types of auditor's report. And describe how to read balance sheet, profit and loss statement, and cash flow statement.
Having explained you friends about the importance of the balance sheet, let me first explain you in the next step what is the importance of the balance sheet, what is the importance of balance sheet, one which is audited, and which are the basic principles on the basis of which balance sheet is prepared. It is equally important to know the basic concept, the basic principles, the generally accepted accounting principles, the various accounting standards which are equally relevant and which forms the basis for the preparation of the balance sheet. And then I'll be explaining you what comprises of balance sheet, what is importance of auditor's report, and which are the various types of the auditor's report. Having explained the various types of auditor's report, there is an important report available as an annexure to the auditor's report known as Report on Internal Financial Control. I'll be explaining you in details about the importance and how to read the report on internal financial control. Then friends, I'll be taking you through the importance of the Caro report and how to read the Caro report, and thereafter how to read the balance sheet, how to read the statement of profit and loss account, how to read the cash flow statement, importance of significant accounting policies, and finally the importance of the notes on accounts. As you know friends that significant accounting policies and notes on accounts are integral part of the financial statement, and therefore analysis of the same is equally important, and our analysis of balance sheet is not complete unless we understand the importance of significant accounting policies and importance of notes on accounts. Coming to importance of the balance sheet, the balance sheet is such an important part of the financial statement that the entire bunch of financial statement, as I said in the beginning, is loosely known as balance sheet. And balance sheet indicates the health of the company, and therefore balance sheet is one of the most important part of the financial statement. I'll be explaining you in details after explaining the importance of audited balance sheet separately, how to read the balance sheet and what is the importance of the balance sheet. Before that, let me explain you the importance of the audited balance sheet. As we know that all the regulators, all the stakeholders rely heavily on the balance sheet. Which balance sheet? One which is audited. audited by whom? By the statutory auditor of the company. And therefore, in a layman's language, an audit is a work carried out by the statutory auditor of a company for certifying about the correctness of the balance sheet, correctness of the statement of profit and loss account, correctness of the cash flow, and various other information as annexed to the financial statement. Friends, auditor's report is signed only by the statutory auditor and not by the management, unlike balance sheet, statement of profit and loss account, and all the notes and significant accounting policies are signed by the both management as well as statutory auditor, whereas auditor's report and annexure to the auditor's report is signed only by the auditors because it is the culmination of the work of the audit, and since it is known as mouthpiece of the auditor and a medium of communication with the stakeholders wherein the auditors is giving certain vital information as available in the financial statement, and therefore it is known as the mouthpiece of the auditor's report. The importance of the audited balance sheet, the first point to understand and is to understand that entire audited financial statement auditor is expressing only an opinion and it is not a certificate by any means. There is a vast difference, friends, between a certificate and an opinion because certificate is without any disclaimer, whereas opinion is subject to certain disclaimers. As you read the auditor's report, you will find there are various disclaimers made by the auditors, and that is why across the globe, the auditor's report is known as an opinion. Opinion on the financial position of the company, opinion on the balance sheet, opinion on the statement of profit and loss account, etc. In this slide, friends, we are going to explain you the basic principles on the basis of which balance sheet is prepared. As I said in the beginning, unless we know that which are the basic principles which governs the preparation of the balance sheet, the analysis of the balance sheet is not possible to complete. And therefore, before we proceed further into analysis of the balance sheet, in this slide, the basic principles are being explained. The basic principles are number one, that accounts of the company are prepared on the basis of historical cost convention. Historical cost convention meaning thereby all the transactions are recorded at the actual amount. That is known as historical cost convention. And further, the balance sheet and books of accounts are prepared on the basis of accrual basis of accounting. There are two methods of accounting. One is cash method of accounting and other is accrual basis of accounting. Cash basis of accounting is not applicable in the case of a company. The Companies Act has a mandatory requirement that every company has to prepare its books of accounts and so as to balance it on the basis of accrual basis of accounting. Cash basis of accounting is normally followed by doctors and chartered accountants and advocates where all the receipts and payments are counted on the basis on which the transaction has taken place. Irrespective whether the payment is received or not, if the sales has been made by the company before the year, it is considered as sales and the balance outstanding is shown as trade receivables. This is what the following the accrual basis of accounting. And further, there are certain generally accepted accounting principles which are known as gaps. So the balance sheet is prepared on the basis of following all those generally accepted accounting principles in India. And further, friends, the Ministry of Corporate Affairs has notified the accounting standards under Section 133 of the Companies Act 2013, read with Rule 7 of the Companies Accounts Rule 2014. And accordingly, there are various accounting standards applicable. Some of the accounting standards may be applicable to some of the companies. All the accounting standards may not be applicable to a particular company. And therefore, when the books of accounts are prepared, when the balance sheet is prepared, it is being kept in mind that all the relevant and applicable accounting standards has been applied by the company. Apart from the generally accepted accounting principles and accounting standards, there are certain other provisions of the Companies Act which are also applicable, and all those relevant provisions of the Companies Act are also kept in mind when books of accounts are prepared and the balance sheet is prepared on the basis of such books of accounts. And then further, there are certain pronouncements made by the Institute of Chartered Accountants of India on certain accounting treatment like foreign exchange fluctuation, like amortization of the cost, like expenditure earned in foreign currency, etc., etc. All those pronouncements, as relevant and applicable to the company, are also required to be kept in mind at the time of preparation of the balance sheet. Then, friends, if a company is a listed company, there are certain guidelines issued by the Securities and Exchange Board of India, known as SEBI, and to the extent applicable to the company, all those relevant guidelines issued by the SEBI are also required to be complied with. Then, friends, there is an Schedule 3 to the Companies Act, according to which there are certain mandatory requirements of the disclosure and presentation. So, the entire balance sheet is disclosed and presented as per the requirement of Schedule 3 to the Companies Act 2013. Apart from above, there are certain generally accounting principles which are relevant for determining the accounting policies, and these generally accepted accounting principles or known as generally accepted accounting concepts are as under. One of them is going concern. Going concern meaning thereby when the balance sheet is prepared, it is always presumed that company is going to be a going company. If a company is into a winding up stage or not a going concern, the accounting treatment will be altogether different. Further, as I explained that balance sheet is prepared on the basis of accrual basis of accounting, meaning thereby it is prepared on the basis of mercantile system of accounting, wherein the accounting period is of most significant. All the transactions which has been taken place during the period during the year are to be considered as a part of that year, irrespective of the fact whether payment is received or payment is not received. Then, friends, materiality is another important accounting concept because all the transactions are to be grouped, presented in the balance sheet, considering the materiality and aggregation principles. Then, friends, offsetting. Offsetting meaning thereby an entity is not generally allowed to offset assets and liabilities or income and expenditure, meaning thereby if the company has earned interest on certain fixed deposit, the same is an income and required to be shown under the head other income. And similarly, if the company has taken certain loan on which company has paid the interest, it is required to be shown separately on expenditure side of the profit and loss, and both cannot be set off. Income is also required to be shown separately, and so as to expenditure is also required to be separately. Then, friends, frequency of the reporting, meaning thereby we know that every company has to follow the March as the accounting period. So that is what frequency of the reporting. Meaning thereby on every March company has to prepare the balance sheet, and if it is a SEBI registered company, there are quarterly unaudited results are required to be published. So that is known as frequency of the reporting. And friends, you are maybe aware that when a balance sheet is prepared on a March of a particular year, the comparative information of the preceding previous year is also required to be provided because that is based on a generally accepted accounting concept of comparative information. Comparative informations are required to be provided so that when the balance sheet is gone through, when you're reading the balance sheet, you must be aware about what was the position of this particular item, maybe income, maybe expenditure, maybe assets, maybe liability with respect to the corresponding previous year. And that is why that is what known as comparative information. Friends, having explained you the concept of accounting principles and etc., now let me take you what comprises of the balance sheet. Though every one of you may be aware that the balance sheet is comprising of the various documents. These documents are starting with auditor's report, which normally you will find in the beginning of the report. Then there is an annexure to the auditor's report known as Company's Auditor's Report Order, which is in short referred to as the CARO report. Then, friends, we have the balance sheet, thereafter followed with statement of profit and loss. Then there is a cash flow statement, followed with significant accounting policies, notes on accounts, and director's report. Director's report is not the end, but normally it is found in the beginning of the financial statement. But for the purpose of reading of the balance sheet, director's report is the last priority, and the most important is the auditor's report, company's auditor's report order, balance sheet, and statement of profit and loss. That is why the director's report has been referred as the last item of what comprises of the balance sheet. Coming to the first part of the balance sheet, that is auditor's report, let me first explain you the importance of the auditor's report. In order to properly understand the financial statement, one has to carefully read the auditor's report, grasp and understand the basic concept of audit, particularly the concept of audit in India, understand the role and responsibilities of the auditor because it is the role and responsibilities as defined under the Companies Act and as per auditing standards issued by the Institute of Chartered Accountants of India, the role and responsibilities of the auditors plays an important part while analyzing the financial statement of the company. Then friends, the role and responsibilities of the management is also very important to understand because the role of the auditor is to certify the accounts prepared and kept by the management. The auditor is not responsible for the preparation of the accounts, and therefore the role and responsibilities of the management is equally important. And then friends, what is the nature of the statutory audit that needs to be understood? That will be explained in the next slides, next presentation. And importance of a particular issue as referred by the auditors in the auditor's report is also very, very important. Having understood the complete concept of audit, it is very clear that auditor's report is only an opinion and not a certificate. It is said that auditor is like a watchdog and not a bloodhound, meaning thereby auditor is expressing only an opinion and he is not issuing a certificate. It indicates that a true and fair view of the financial statement. So moment it is said that it is a true and fair view, meaning thereby I don't say that it is free from fraud. It is free from misrepresentation because moment there is a fraud, moment there is a misrepresentation, the true and fair view of the financial statement will be affected. But the auditor's report indicates that the balance sheet and statement of profit and loss as annexed to the balance sheet indicates a true and fair view of the financial statement of the company. Friends, having explained the concept of audit, what is auditor's report is about, what is the roles and responsibilities of the auditor. Auditors is only issuing an opinion on the true and fair view of the financial position of the company.
It's 6:30.
Let me explain you there are various types of the auditor's report. Therefore, auditor's report can be divided at the outset into two parts, one clean report and second modified report. Clean report meaning thereby auditors has not either qualified the opinion or not issued any adverse opinion, meaning thereby all the accounting standards as applicable to the company had been followed, all the generally accepted accounting principles had been followed by the company, meaning thereby the conclusion can be drawn if the auditor's report is a clean report that the disclosure made in the statement of profit and loss and the disclosure made in the balance sheet is true and correct, true and fair, and no adjustment is required to be made so far as what is disclosed in the audited financial statement. As against clean report, if auditor come across a view that certain information has not been properly disclosed by the company in the books of accounts so as to into the balance sheet, auditors may issue a modified report. And therefore, the modified report is divided into three parts. One, qualified report, second, adverse opinion, and third, disclaimer of the report. Let me explain you in brief details with a case study with respect to qualified report. Let us say that the company has taken certain loan from the bank on which interest is required to be provided, but management has decided not to provide the interest, and therefore to the extent interest is stated lower by the company and to that extent of interest profit is overstated. So therefore auditors may come across such case where the interest is not properly provided. He may issue a qualified report stating that company has not provided full interest on the loan taken by the company, and therefore to the extent of interest not provided, profit is overstated and liability is accordingly understated in the balance sheet. This is what known as qualified opinion. Let me take you to the case of a adverse opinion. Adverse opinion meaning thereby if auditors during the course of audit come across an issue where certain disclosure has not been properly made, he may issue an adverse opinion. Adverse opinion may be with respect to certain accounting transactions, certain adjustment made by the company, or certain issue which has come to his knowledge during the course of the audit, and all those issues are required to be disclosed by the auditors in the auditor's report under the head adverse report or adverse opinion. And the last type of modified report is disclaimer of opinion. Disclaimer of opinion meaning thereby auditor is not in a position to form an opinion, and therefore it is known as disclaimer of opinion or known as disclaimer of report. For example, let us say there is a company has various branches across the India, and out of various branches, proper books of accounts has not been kept at the Mumbai branch of the company, and therefore auditor may state that so far as operations of the Mumbai are concerned, the sales, purchases and various expenditures relating to Mumbai branch is not properly audited in absence of documentary evidences, and therefore he may state in the auditor's report that the revenue of the Mumbai branch of rupees this much out of the total revenue of the company of rupees this much, and total expenditure of rupees this much out of the total expenditure of the company, and therefore he may issue a disclaimer of opinion with respect to particular branch. Friends, disclaimer of opinion or disclaimer of report may be with a particular branch, may be with a particular unit, may be with a particular undertaking, may be with respect to particular operations of the company, or if a company has certain subsidiaries and if one of the subsidiaries has not kept the proper books of accounts and proper records, he may issue a disclaimer opinion with respect to that particular company or a subsidiary when he is issuing a consolidated auditor's report. And therefore, it is very important, friends, to read the complete auditor's report, because by reading the auditor's report, you will come to know whether the report issued is a clean report or it is a qualified report or a adverse report or a modified report or a disclaimer of opinion. Friends, as I said that as an annexure to the